Hello everyone and welcome to the Weekend in Review and Look Ahead Special Edition. Yes, Special Edition. We are doing our 6-month review because the trading year is halfway over and it's just time to go and look back at what a year so far it has been. So I am only doing 6-month charts, no interdaily charts and stuff like that. Just to go and review some of the stuff that's been going on. Here, I'm gonna even just so you don't see all this stuff and get distracted because we're only doing charts here. Here is so far what the Dow has done for the year. Now, if you notice, it's traced this 21-day moving average pretty finely around June, pretty much June to the first start of July. Yes, we are over 17,000 on the Dow. I mean, just look at the first kind of month, the first, kind of here's January to February volatility. I know the theme for the second quarter has been low volatility, and really I think it's because we had so much volatility in the first half of the year, or the first quarter of the year. As we can see here, we pretty much made up all of our gains, just kind of really choppiness, and then as soon as we got through about mid-April, we started continuing our uptrend up of the bull market that has been going on. Now this continues to be that theme for the SPY. The Dow being the worst performer so far of the year, if I remember right. So once again, looks very, very much so like the chart of the Dow that we were looking at earlier. First start of the year, things looked positive. Ukraine hit, and all that, and then it just kind of started declining. Then we kind of made these slow grinds higher throughout the year. Oh, I went back to the Dow. I'm not even going to use the QQQ. I'm going to go to Market View. I apologize, I have a house full of family right now, so there may be some background noise, and this was the quietest place that I could find. So same thing kind of with the NASDAQ, and then we got into spring where tech really got slammed. NASDAQ really hit some of those lows and then continued on through, and I'll go even to the IWM, which is the Russell, just so we can see what the Russell's been doing. And I have some channels drawn through because I showed the weakness that the Russell been having for so much of the year. Then it kind of bottomed around, here with this kind of hammer formation here on about May 15th, and then just kind of start this slow grind higher to where it's just become, back towards the highs of the year. So small caps for a while just got absolutely hammered. And I think one of the themes for this year has been rotation. We saw the rotation out of tech, or new tech that was blazing the way for 2013, and we saw the rotation to old tech such as IBM, Microsoft, stuff like that. And here's another theme of the year: volatility. Really high spiking volatility at the beginning of the year, fade, decline, couple more spikes near 18, and then this decline lower into where we are, which is pretty much all-time lows for the VIX. It hasn't, I don't think, ever broken. It hasn't ever broken below 10. I think this is one of the first times that it's actually closed and held below 10 for any type of period. And what the VIX really does is measure volatility and fears. It's calls to put ratio over at the CBOE, or the Chicago Board Option Exchange. And low VIX is actually very good for investors because that means low volatility. And in this case, for this market, it's been low volatility with an upwards sloping market, or like a grind higher for the market. No, traders kind of hate this market because there's not a whole lot of volatility, so there's not so much that they can trade, not a whole lot of movement that they can do. But for investors like some of us, we can take lots of advantages to this kind of low volatility, really grinding higher movement. And that's find good, solid companies and just kind of like let them go. We don't have to worry so much, when there's low volatility, because for us, whenever we see big spikes in volatility or whenever we see these movements in the, 200, 300 point declines in the Dow and stuff like that, we get very worried as long-term investors, because these are the things that, catch our eye, not the 20 points lower or 10 points higher and stuff like that. These big these big downward movements that longer-term investors, kind of like myself, do look at. Now, I also think for a longer-term investor that you need to pay attention to the VIX a little bit for opportunities like this. I mean, the VIX breaks 10. I think you buy very, very long, outdated protection, like, February. Can you even Now, I have to say, I'm not too much of an options trader, but I do say, if it breaks below 10 and we're in June, maybe you buy the January 14 calls, something that's way outdated, just in case we do run into a correction, a small decline, something, like the spring-ish had for tech type of a thing. And we see this happen. That way, you're hedging your portfolio for for very, very cheap, but still long dated, so you minimize some of the risk there. I kind of want to highlight some of the stocks that's been going on in my portfolio. So over the 6 months that I've had them hedge, I've been a holder of this. I actually have an open order for when it breaks 1150, because that's going to be very, very. Let's look at the 52-week range. Hopefully, I clicked the last. I know that is the other stuff. 52-week range. It's basically at the lows of its 52-week range. So I said, what? It's a great place to buy, because I got some. I now have a lot of cash in hand. Looking at my summary, yes, you can see my account value. I am 40% in stocks and options, and I did do some buying. I think on Wednesday I did some buying. I reallocated some of my portfolio. So stuff like Under Armour got bigger just because I like the level where it's at 60. Starbucks got bigger because I think anything under 80 is an awesome buy. It's going to be 80 by the time the summer's over. Hedge is still at 12%, so I want to increase that. I bought some V because I think it's breaking out, and I think it's gonna and V is actually something that I really, really want to highlight. I really highlight for later in the video as I get to my main theme of what I think this next part of the year is going to be. And then also I bought some XLU just because it has had a bit of a decline. And I really, really, once again, like being able to have some of my cash in something that yields 3%, whether utilities go up, down, sideways, whatever. Going back to charts for my positions, hedge, as we see, it really got up in February, and then here I'll even go and display trades for you guys, just to go and show you like some of the moves I did. This is one of the few moves that I've actually gone and did display trades. Oh, it's not doing it. That's just fabulous. Exit out of this. Maybe if I go and do this, it will work. Go show trades. Nope. Okay, sorry guys. But I bought it around here-ish. And basically I've been riding it through. I've lost money, yes, but it is a hedge, and I do like to stay hedged because I did think that this year was going to be very, very volatile. And through pretty much, June through February, it kind of coincided and it agreed with my theory. And then in the spring, it helped with my theory, as you can see these big pops. And then along with volatility going down, protection in general has gone down. So I thought this is a great place to go and buy some protection. If it just sits there and does nothing, at least 20%. Plus, I also count as XLU as a hedge against, some of my high flyers, or kind of the more vulnerable names like Michael Kors, like Under Armour, like Starbucks to an extent, that are vulnerable to these big kind of swings. That way I still have things that go and kind of minus out that return. So I count XLU as almost like a hedge to me as well. JP Morgan, I've held this for forever. And I think this also attributes to one of the things, I think one of the big themes for this year, for this next quarter, is buy things that have really underperformed so far, because that's where the value is. In the spring, we saw a switch from, Facebook and Twitter and all that stuff, which was the big kind of performers of last year, to stuff that has underperformed, like IBM and Microsoft. And that's why utilities kind of went up a little bit. I'll get to that a little bit later. But as we can see here, JP Morgan off those bad earnings, I think they may have some bad earnings again just because the trading volumes are lower. But you look at this 58 line, and that's right where it was right at the start of the year. It's pretty much flat for the year. I think, if you want to buy some JP Morgan right here is a great place. Still pretty much undervalued. Going to Michael Kors, still has had a hell of a year, I have to say. Pardon my language, but this was a 20% move right here. And I'm still very, very happy that I own some. Sitting at 90 here, we had some choppiness here, had some choppiness down here. Sitting here at 90, I really, really like it. A whole bunch of other people like it. The stock is getting beaten up, but I still think it's going to be great to own. I still think they have a lot of earnings growth ahead, and it has performed, and that's kind of why you saw it got beat up a little bit. But I do think people will still go and see some of that growth name. AIG has risen quite a lot this year when you look at it. That 52 line. Is that 52? Yeah, 52 line where we started off. Kind of with the broader market slowed down, and then around April started going ahead and run up into earnings right here, slowed down, and it's been flirting with these 52-week highs even on this past shortened trading day of Thursday. It flirted with those 52-week highs. It's been a great asset to go and have. It's been one of those undervalued, so we're gonna buy it. It's still pretty undervalued. Even here, when you start factoring in its, tangible book values and all of that, and some of the other fundamental analysis, and it's still pretty undervalued. I think of it almost as like a utility type thing. I think it's one of those names that you'll see a lot of people reaching for. A lot of hedge funds hold it, and it also, they've been shoring up their balance sheet like no one's business. I've been seeing a lot of news coming out about, they're paying off more debt, increasing some capital of shareholders that they actually have. When they sold off their jet leasing business, that gave them a lot of cash, and that jet leasing business was actually a whole lot of debt that was on their balance sheet that allowed them to clear that debt, pay off some other debt, increase money to shareholders. And I think that's just a winning combination. They're starting to get less and less debt on their balance sheet, and I think that's going to just be fantastic for them as the year goes on. Under Armour. Ooh, it shows a trade here. So Under Armour. Oh man, I just remember during the Olympics right around here when I was like, you know what, I should buy it. It was like right on this dip. When it had come down, I was like, you know what, I need to buy it. It was like this dip, and then it exploded upwards, and I got in around, I have multiple positions in Under Armour. I got in like at 114, so like right around here. Enjoyed the upward success of it all the way through here. Rode this pretty much 20% decline. We dipped below earnings, almost filled that gap. Refilled this kind of downward move over here when it rallied, all through this. And I think it's been holding here at 60 for a while. Now, the reason why I say 60 is such a big level, let's go back to a 10-year chart. Let's go and draw lines for the candles, even those aren't the closes or the highs. Still goes and forms a kind of near 60, and that just seems to be a level that likes to gravitate towards even this massive upward candle here. We'll just see it's just almost drawn to 60 level. You can go and bring up the chart even more so. We're talking long-term charts here, and still it goes back to that level. And I just think it keeps on going higher. It hasn't even reached Europe yet. earnings growth. I mean, World Cup action as well. Really like the stock. A lot of high conviction for it. Going to Starbucks, which kind of went and brought forth some of my thesis about the end of this year being, or this kind of starting in May of, okay, let's buy the stocks that have underperformed. And you can clearly see here, started off the year at around $78. It's now slightly above 78 at 79. And, you know, tipped up right here at 78. Lower, got really beat up, flirted with 68 for a while. You know, I pounded the table saying, you know, buy this and get under 70. I couldn't personally, but see about it here right before this breakout. I think it's going to 80 fast. I think Starbucks is starting to really nail it. They're integrating Tivana. Clear, nice upward trends here. You know, it's a stock that got beat up a lot this year because of quote-unquote higher coffee prices. There was a pair straight going on, short Starbucks, long coffee. Starbucks hedges their coffee, and when they blew out earnings, everyone went, okay, never mind. And ever since then, it's really been on a tear. I just love this stock. I think I see a lot of future going for it. It's also a tech. It's got some tech exposure in the sense that it's got its proprietary payment system and association with Square, which it does own some of. So you have that also in it as well as along with what I think they're going to do. They experimented with the Frap truck, which is a Frappuccino truck, which is like a food truck but only serves Frappuccino. They only let people pay with cards, their Starbucks app, Starbucks card, or credit cards, no cash. I talk to baristas, they say they love that stuff. They love not having to deal with cash and stuff like that anymore. You can give them tips on the app. And I can see in major markets, you know, I'm talking New York, Chicago, Las Vegas, you know, these heavily populated areas where sometimes real estate is really expensive. I can go and see Starbucks, you know, making these mobile coffee trucks, these food trucks for coffee. I just see them ripping apart, you know, the competition with that. I think that's, you know, the next Starbucks move. Okay. XLU. It's no surprise to everyone that utilities has led the way here. I did kind of follow the hedge eye trend saying, you know, they liked utilities and stuff like that. I think this decline is something that needed to be bought. So what did I do? I went in and bought pretty much near my other trade line here as well. These are all the trades I made in Trade Monster, by the way. I did have some with Scott Trade, as you guys know. I think as long as it doesn't reach below 42, which in this past decline, 42, bounce up, new highs. I think you can continue to see some nice growth in utilities as long as rates don't really move up too much, like near 3%. I think utilities are a solid play. I think the economy is growing, maybe not as fast as we want it to. It's that slow grind. Once again, I think utilities really rock out in that environment. They pay a lot of nice. They pay for good cash. And I think these next round of earnings, you're really going to see utilities really rocking out. Due to some of the cold weather, due to some of the environments, you know, a lot of these companies provide heat, provide electricity, stuff like that. A lot of it was used to go and heat their homes. You know, I think that's going to really help them forward. I think, you know, in something that's yielding 3%, I don't see why not to go and put some money into utilities. People have been talking that industrials are the next thing forward. I would agree to that just because they haven't really XL, I think it's the XLI maybe for industrial. Yeah, see, it's been kind of pretty much flatline right here at 52. Just recently been rising up, rose when utilities fell. I think this is the next thing that people are going to shift a little bit to. Sorry that's changed, but I actually can't own it because my dad runs a division for Emerson Electric, which is in XL. It's kind of like a conflict of interest thing. He owns a lot of Emerson shares, So I just don't mess with stuff like that, because I used to ride with him in the car and hear conference calls. I've never traded Emerson ever in my life, nor will I ever. I don't like messing around with that stuff, so I just stay clear of that stuff. That's why I say, industrials, you probably should. That seems like the next logical rotation, just because they've been an underperformer. Energy, XLE, has been really, really good, along with some of the other energy names. Very, very similar to what we've been seeing in the utilities. I think the next logical move is industrials, and whether that be whatever industrial you can get your hands on, not necessarily Emerson Electric, just because of my disclosure stuff. Visa, oh my God, talk about an underperformer. Look, 2020. If you guys have seen some of my other 220. Well, if you guys have seen some of my other videos, you've heard me talk about Visa, about this level, about 223 for forever now. And, this stock has been getting a lot of traffic, been rising to the upside. I think this is another one of those stocks when you start looking at Starbucks breaking out just like it has right here. We go, and it's that switch to stuff that didn't work out, or stuff that's underperformed, and I think that's really what's going to lead the way. Another stock that I'd like to highlight that has had a massive, really, really awesome run, and I wish I could be a part of, is Disney. Oh my God, I really want to buy this stock, but I can't, just because it's at 52-week highs, and it's irking me so much. It has outperformed since the year, so I don't think it's susceptible to a decline, to a terrible decline. Their earnings are going to be awesome. World Cup, they own ESPN. Imagine the ratings here. Frozen, they're just going to start merchandising that. Theme parks are going to start picking up because of the warmer weather. Disney is just, I would like to buy it on a pullback. I really, really want a pullback. That way I can just go in and just buy hand over fist. Because I think this is a stock that has multiple years of growth. They're working Maleficent. My girlfriend saw it. She loved it. I can start seeing Maleficent rides. I think Disney's on a tear here. I think they've got this solid 4-year window of stories that they've been doing. A lot of people I talked to, a lot of passionate Disney people. When I was at the International Thespian Festival this last week, I was able to talk to some people that are really passionate about Disney. I actually met the lead lighting designer for Disney theme parks over in Anaheim, California. But a lot of people I talked to at the Thespian Festival who are really into Disney were talking about some of the movies. Frozen was original, but they've been saying that they've been seeing these remakes of these movies, like Maleficent is kind of Snow White-ish, the other side of Snow White and the Seven Dwarfs. Very much like that. But, that they've been remaking these old-time classic type things, and they can only do that for a couple more years before they have to start making new stories. And I think that's that window that you get where people who are still familiar with the old stories will buy the merchandise and get their kids to watch it, stuff like that. I think that's what really makes Disney such a great buy here. I just need a pullback. I still think it's going to perform. Like I said, World Cup earnings, you're going to start seeing more traffic to the stores, great movies with great merchandise. And I think we're going to have to end it right here. Guys, I'd like to thank you, all of you who have been following me for the past 6 months or longer, have been watching my videos. Hopefully I've been helping you guys out a lot. I love hearing stuff from you. I'm sure if you follow me on Twitter, you noticed that I like to go and carry on conversations on Twitter with people. And I just want to say, keep your minds open out there, guys. Don't just watch CNBC. Maybe watch Opening Bell with Maria Bartiromo on Fox News. Despite the fact that I think Fox has its major biases, Opening Bell is a really solid show. Maybe if you are a diehard Jim Cramer fan, look at Hedgeye a little bit and see stuff that they're reading. Keep your minds open. Still keep gathering information from several different sources. Stay flexible out there. If you see great buying opportunities, go in them. Keep some stuff in mind. Don't buy on 52-week highs. Like I'm saying, I really want to buy Disney here, but you gotta wait for a pullback or something like that because they don't want to buy, at a 52-week high. Just superstition, knocking on wood right now. Just stay nimble out there, guys. Low volatility necessarily isn't a bad thing for longer term positions. I mean, if your longest term position is 2 weeks, then yeah, it is kind of bad, but I'm talking about multiple months, multiple years. It's great for those types of positions. Take hedges where you can, whether that be buying HDGE here at the lows or VIX at the lows. Just take the opportunities that are given to you. Stay nimble out there. Or can have a great rest. Hopefully, we all have a great rest of the year. Please follow me and all the rest of the Leaders Investment Club members. Great Business Insider article just came out. Talked about the most important people in finance in every age. John Dukas got 16. Julia Marchese got 17. I believe John Paul Pigeon got 19, and then our very own Nolan Parker, along with all the other guys, of course, got 20. It was awesome to see all of them on there. A lot of Leaders members. Please support all of them, and hopefully you guys reach out to me. I'm more than willing to answer any of your tweets, any of your emails, and let's keep rocking it out there, guys. Thanks for watching.